Welcome! Today we're going to examine a company that became a symbol of an era of unprecedented venture capital, of growth at all costs, and of the extraordinary risks that come when vision outruns fundamentals. That company is WeWork. WeWork's story is one of the most dramatic in modern business history. It soared to a valuation of $47 billion, promising to revolutionize the way we work. Then it collapsed in a spectacular failure of governance, business model, and capital discipline. And now, after a painful bankruptcy and restructuring, it is trying to rebuild, quieter, smaller, and more focused. What can we learn from WeWork's rise, fall, and attempted rebirth? This is not just a story about one company. It is a case study in the fundamentals of strategy, how to build a sustainable competitive advantage, how to govern a fast-growing organization, and how to recognize when a compelling narrative is masking fragile economics. We'll walk through WeWork's history, its current strategic position, its competitive advantages or lack thereof, its governance failures and reforms, the risks it still faces, and the key strategic lessons every business leader and strategist can draw from its experience. Disclaimer: this video does not constitute financial advice. The investment philosophies and academic theories discussed herein are provided solely for the purpose of sharing opinions. The analyses expressed reflect independent, personal viewpoints and are not endorsed by, affiliated with, or representative of any financial professionals or educational institutions referenced. The creator expressly disclaims any liability for financial losses or damages arising from investment decisions made based on this content. Let's begin. Part 1: The Rise, a narrative that captured the world. The founding idea, from 2010 to 2014. WeWork was born in New York's Soho district in 2010, the brainchild of Adam Neumann and Miguel McKelvey. Their idea was simple yet seductive: take large, underutilized buildings, renovate them into beautiful, community-focused workspaces, and rent them out on flexible terms. They called it space as a service. But Adam Neumann was not a typical entrepreneur. He was a charismatic, larger-than-life figure who saw WeWork not as a real estate company, but as a movement. He talked about elevating the world's consciousness and creating a global network that would change how people lived and worked. Investors, especially the venture capital community, were enchanted. The SoftBank infusion from 2017 to 2019. The turning point came when Masayoshi Son, the founder of SoftBank, decided to bet big on WeWork. Son, who had made fortunes with investments in Alibaba and Yahoo, saw WeWork as the next big thing. Between 2017 and 2019, SoftBank poured over $18 billion into the company, driving its valuation to a staggering $47 billion. At the time, WeWork was opening locations at a dizzying pace, from a few dozen in 2015 to over 800 worldwide by 2019. It was adding hundreds of thousands of square feet each month. The narrative was intoxicating. WeWork was a tech company that would disrupt the $3 trillion commercial real estate market. But behind the curtain, things were far from rosy. The company was losing money at an alarming rate. For every dollar of revenue, it was spending more than $1.50. Its business model was essentially a giant arbitrage. It signed long-term, fixed-cost leases with landlords, then rented the space out on short-term, flexible terms to members. This created a massive mismatch. If demand fell, WeWork was still on the hook for decades of rent. The unraveling, 2019. In August 2019, WeWork filed its S-1 prospectus for an initial public offering. That document, meant to be a celebration of the company's success, became its undoing. Investors were horrified by what they saw. Huge losses, over $900 million in the first half of 2019 alone. A governance structure that gave Adam Neumann near total control. A litany of self-dealing. Neumann had bought buildings that he then leased back to WeWork. He had trademarked the word "we" and sold it to the company for nearly $6 million. He had taken out a $7.5 million loan from the company, and he used company funds to charter private jets and buy a private surfboard company. The IPO was pulled. Within a month, Adam Neumann was ousted as CEO, receiving a $1.7 billion exit package from SoftBank. Company's valuation collapsed, and the once vaunted unicorn became a symbol of Silicon Valley excess. Part 2: The Fall, Bankruptcy and Reckoning. The pandemic and decline from 2020 to 2023. The pandemic dealt a second blow. With offices empty and remote work becoming the norm, WeWork's occupancy plummeted. The company tried to pivot, cutting costs and renegotiating leases, but the damage was done. In November 2023, WeWork filed for Chapter 11 bankruptcy protection, with liabilities estimated between $10 billion and $50 billion. The restructuring 2024 bankruptcy, while painful, gave WeWork a chance to reset. During the court-supervised process, the company accomplished what many thought impossible. It eliminated over $4 billion in debt. It renegotiated or terminated hundreds of expensive leases, reducing its future rent obligations by more than $12 billion. It exited around 170 unprofitable locations, shrinking its global footprint to about 600 locations. It converted much of its debt into equity, bringing in new owners. Yurdi Systems, a real estate software company, took a 60% stake. SoftBank's ownership was diluted to 20%. In June 2024, WeWork emerged from bankruptcy as a private company, with a new CEO, John Santora, a veteran of the commercial real estate industry, and a board dominated by professionals rather than founder allies. Part 3: Today, a leaner, more disciplined operator. The numbers. As of early 2026, WeWork is a much smaller, more focused entity. It operates approximately 600 locations in 37 countries, down from a peak of over 800. Its membership base has stabilized at around 500,000 members, with a heavy focus on enterprise clients, Fortune 500 companies that need flexible workspace solutions across multiple cities. Financially, the company has achieved 6 consecutive months of positive EBITDA, earnings before interest, taxes, depreciation, and amortization, for the first time in its history. Occupancy in key markets like New York is running at 87%, a sign that demand for high-quality, flexible office space remains strong. The business model shift. The most important change is in the business model. Pre-bankruptcy, WeWork was a traditional lease arbitrage model. It signed long-term leases, took on the full risk, and sublet space. Today, it is shifting to an asset-light model. It increasingly enters into management agreements and revenue-sharing partnerships with landlords. Under these arrangements, WeWork acts as an operator, taking a percentage of revenue rather than bearing the fixed cost of the lease. It is expanding its software business, selling its WeWork workplace platform to corporations to help them manage their own hybrid office environments. This is a higher margin, less capital-intensive business. This pivot reduces WeWork's exposure to fixed costs and aligns its incentives with landlords. It also moves the company closer to being a technology-enabled services provider rather than a pure real estate subletter. Part 4. The moat question: does WeWork have sustainable advantage? From a strategic perspective, the first question is always, does the company have a durable competitive advantage, a moat? For WeWork, the answer is complex. What it has: 1. Global brand recognition. Despite the bankruptcy, WeWork remains the most recognized name in flexible workspace. It is a category creator, much like Uber for ride-sharing. This brand equity matters when corporate clients are choosing a partner for global offices. 2. Network effect. With locations in over 30 countries, WeWork offers a seamless experience for global employees. A member in London can walk into a WeWork in Tokyo and have the same access. This network is difficult for a local competitor to replicate. 3. Operational expertise. After more than a decade, WeWork has refined the art of designing, building, and operating co-working spaces. It knows how to maximize utilization, manage community events, and provide hospitality-level service. This operational know-how is a genuine differentiator. For technology, its app and management software handle everything from booking to access control to space utilization analytics. This technology platform is now being monetized separately as a software-as-a-service offering. What it doesn't have: one structural moat. The core business is still fundamentally a service business with low barriers to entry. A landlord could decide tomorrow to offer its own flexible office service and undercut WeWork. There are no patents, no proprietary technology that can't be copied. 2. Switching costs. A freelancer or small business can leave WeWork with a month's notice. There is little friction in switching to a competitor like Regus or to a local co-working space. 3. Pricing power. In a downturn, WeWork has to cut prices to fill space. It does not control its own destiny. So the strategic verdict: WeWork has brand and operational advantages, but these are narrow and require constant execution to maintain. It is not a fortress. Part 5. Governance: from cult of personality to institutional discipline. WeWork's governance story is perhaps its most important legacy. The Dark Ages pre-2019. Under Adam Neumann, governance was essentially non-existent. He held supervoting shares that gave him 20 votes per share, giving him total control. The board was stacked with his allies. He engaged in multiple self-dealing transactions, leasing buildings he personally owned to WeWork, taking out company loans for his personal investments, and using company money to buy luxury items. When the IPO prospectus revealed these details, it was a shock to the market. The rebuild from 2024 to present. Today, WeWork's governance is a complete reversal. The company is controlled by Yardi Systems, a professional institutional owner. The board is comprised of real estate and technology executives, not friends of the founder. The CEO is a disciplined operator, not a visionary. There are strict controls on related party transactions, and financial reporting is transparent. However, as a private company, there is less public scrutiny. Investors can't see the details of its financials or its lease agreements. So while governance has improved dramatically, it's now a black box to the outside world. The key lesson from WeWork's governance is clear: growth without accountability is a recipe for disaster. No matter how compelling the vision, a board that fails to challenge the founder and a structure that concentrates unchecked power will eventually lead to collapse. Part 6. 3 Strategic lenses on WeWork. Now let's examine WeWork through 3 distinct strategic lenses. Each lens represents a different philosophy about how organizations should create and sustain value. Lens 1. The quality and durability lens. This lens focuses on the durability of a company's competitive advantage and the predictability of its earnings. Proponents of this lens seek organizations with clear, defensible market positions, strong cash flows, and conservative financial structures. When viewed through this lens, WeWork scores poorly even today. Its business remains cyclical, capital-intensive, and exposed to macroeconomic swings. It has no pricing power, and its earnings are difficult to forecast with confidence. The asset-light pivot improves the risk profile, but the underlying business is still a low-margin service. From this perspective, WeWork is not a quality compounder. It is a turnaround situation that may produce modest returns if executed flawlessly, but it will never be a high ROE franchise. Lens 2. The simplicity and visibility lens. This lens focuses on the understandability of a business. Adherents prefer companies whose operations can be easily explained and whose financial performance can be clearly tracked. They look for businesses that are visible in everyday life, with a simple value proposition. When viewed through this lens, WeWork is a mixed case. The business is simple to understand, it rents desks. But the underlying economics, the lease structures, the capital expenditure for renovations, the occupancy sensitivity are complex. Moreover, WeWork is now private, so its financials are not publicly visible. For a strategist who values transparency, this opacity is a drawback. On the other hand, its brand is highly visible. Anyone who has visited a city center has seen a WeWork. That visibility is a form of strategic asset. Lens 3, the cycle and conviction lens. This lens focuses on the identification of long-term economic cycles. Proponents of this lens are not looking for steady growth, they are looking for turning points. They study supply and demand dynamics, identify industries poised for structural change, and make concentrated bets at the moments of maximum pessimism. When viewed through this lens, WeWork becomes a compelling case study. The flexible office market was crushed by the pandemic and the rise of remote work. But now, as hybrid work settles into a new normal, demand for flexible, high-quality office space is recovering. At the same time, many landlords are converting office buildings to residential use, reducing the supply of commercial space. This supply-demand dynamic could create a favorable cycle for the remaining operators. WeWork, as the largest brand in the space, is positioned to capture that recovery if it can execute. But this lens also demands discipline. Those who follow it would have bought WeWork when it was deeply out of favor, and they would have the patience to hold through volatility and the wisdom to exit when the cycle matures. Part 7: Risks and Future Direction. No strategic analysis is complete without examining the risks and the forward strategy. The key risks. 1. Commercial real estate cycle. WeWork's fortunes are tied to the health of office markets. If companies continue to reduce their physical footprint, or if a recession hits, occupancy could fall again. 2. Competition. The flexible office market is crowded. IWG, Regus, Industrious, and local operators all compete for the same customers. Landlords themselves are increasingly offering flexible space, cutting out the middleman. 3. Execution. WeWork's turnaround depends on disciplined cost control, successful lease renegotiations, and the ability to maintain high occupancy. Any misstep could undermine its profitability. 4. Brand legacy. Some corporate clients may still associate WeWork with the Numenera excess and bankruptcy. Rebuilding trust takes time. 5. Ownership dynamics. With Yurdi Systems holding a 60% stake, WeWork's strategy may increasingly align with Yurdi's software business. This could be a strength, or it could create conflicts if Yurdi prioritizes software sales over real estate operations. The future direction. WeWork's stated strategy is to become a mature, profitable flex space operator with a strong technology component. The priorities are: enterprise expansion, deepen relationships with Fortune 500 companies that need multi-city solutions. Asset-light growth, expand through management agreements and franchising rather than signing new long-term leases. Tech monetization, scale the WeWork workplace software platform, turning real estate operations into a higher-margin software business. Selective upgrades, invest in renovating existing locations to maintain quality and attract premium clients. The goal is to achieve sustainable profitability and, eventually, return to the public markets, but this time as a disciplined operator, not a hype-driven startup. Part 8: Strategic Lessons from WeWork. So, what can we learn from WeWork's extraordinary journey? Several lessons stand out. Lesson 1: Growth is not a strategy, it is a result. WeWork's early strategy was to expand at any cost, believing that scale would create a moat. But growth without a sustainable business model is just burning capital. A true strategy requires a clear answer to the question: what is our unique advantage that will allow us to earn superior returns over time? Lesson 2: Governance must scale with the business. As companies grow, the governance structures that worked in the startup phase become inadequate. WeWork's board failed to challenge the founder when he engaged in self-dealing and reckless spending. Strong boards, independent directors, and clear separation of founder roles are not optional, they are essential for long-term survival. Lesson 3: Business models matter more than narratives. WeWork was sold as a tech company, but its economics were those of a highly leveraged real estate business. When the narrative clashed with reality, the valuation collapsed. Investors and strategists must always look beyond the story to the underlying unit economics, capital structure, and risk profile. Lesson 4: Cycles create opportunities and risks. The flexible office market is cyclical. WeWork's failure was amplified by the pandemic, but its recovery is being driven by the normalization of hybrid work. Those who understand cycles can identify turning points, but they must also have the discipline to exit when the cycle turns against them. Lesson 5: Turnarounds are possible, but they require radical honesty. WeWork's post-bankruptcy transformation is a testament to what can be achieved when a company faces reality. It shed billions in debt, exited hundreds of unprofitable locations, brought in professional management, and changed its business model. This kind of radical honesty is painful, but it is the only path to survival. Conclusion: WeWork's story is not over. It has emerged from bankruptcy smaller, leaner, and more disciplined. It has a strong brand, a global network, and a business model that is less exposed to fixed costs. It is benefiting from the recovery in flexible office demand, but it remains a cyclical, competitive business with narrow moats. It is not a forever company. It is a turnaround that requires careful execution and a clear-eyed view of the risks. For strategists, WeWork offers a rich case study in what happens when vision outruns fundamentals and what it takes to rebuild when the tide goes out. It reminds us that growth without governance is fragility, that narratives without economics are illusions, and that the most important strategic question is not how fast can we grow, but how do we build something that can endure. WeWork's journey from a $47 billion unicorn to a bankrupt cautionary tale, and now to a disciplined, privately held operator, is a story of extremes. But the lessons it offers are timeless. Know your business model, govern with discipline, and never confuse a compelling story with a sustainable enterprise. Thank you.